Bank of America, one of Wall Street's giants, has just stunned the market with a silver forecast that sounds almost surreal, a potential price of $309 per ounce. Let that sink in. This is not a mistake. If it materializes, it would mark an increase exceeding 500% from silver's historical peak. Yet, what's striking is that this projection barely touches on the usual narratives of supply shortages or industrial consumption that dominate most discussions. When confronted with a headline like this, most people react in one of two ways. They either dismiss it as unrealistic hype or latch onto it without question. But you will avoid both extremes because the numbers behind this claim can be verified. Bank of America is not simply guessing. There's a precise mathematical approach underpinning their scenario. Their report walks through how returning to a historic ratio could theoretically elevate silver to this extraordinary level. So where does a figure like $39 come from? For years, followers of silver markets have relied on familiar explanations. Analysts focused on the fundamentals: chronic supply deficits where demand consistently surpasses mining output, growing industrial use, particularly in solar panels and electric vehicles, and COMEX inventory levels. Using this classic framework, silver targets rarely exceeded $50 or perhaps $70. In fact, as recently as late 2025, Bank of America itself projected a high-end silver price around $65 based on these traditional factors. But now, they have abandoned that old playbook. Michael Widmer, their head of metals research, introduced an entirely new perspective. The latest price forecasts, including the staggering $309 scenario and the more conservative $39 scenario, hinge not on supply or demand at all. Instead, they focus on a single metric: the gold to silver ratio. This represents a dramatic shift. Bank of America didn't merely adjust their silver target upward, they reframed the entire analysis. Rather than evaluating silver in isolation, they examine its historical correlation with gold, a signal that serious investors cannot ignore. The gold to silver ratio, often abbreviated as GSR, is straightforward. It measures how many ounces of silver are required to purchase 1 ounce of gold. For example, if gold trades at $5,000 per ounce and silver at $100, the ratio stands at 50 to 1. Historically, this ratio has fluctuated mostly between 50 to 1 and 80 to 1. As of early 2026, it hovers near 59 to 1. During major precious metal bull markets, silver frequently outperforms gold, causing the ratio to shrink or compress. Bank of America's new model relies entirely on this phenomenon repeating itself. At its core, the calculation is simply division. That's the foundation. To illustrate, consider their numbers. They first select a projected gold price. Their early 2026 reports suggest gold averaging around $4,538, with a genuine possibility of reaching the $5,000 milestone. For simplicity, we can round to that $5,000 figure. Next comes the ratio. Widmer examined two historical points when the gold to silver ratio plunged to extreme lows. The first reference is the 2011 peak, which provides critical context for how silver behaves when the ratio compresses dramatically. By following this logic, Bank of America shows that silver's potential is tied less to traditional supply-demand narratives and more to the patterns established by its relationship with gold. This approach refar during the quantitative easing surge. The gold-to-silver ratio compressed dramatically, reaching roughly 32 to 1. That was the moment silver soared to its celebrated peak of nearly $50 per ounce. Bank of America's first scenario mirrors that past event. Let's break it down. $5,000 gold divided by a 32 ratio equals $156 per ounce of silver. In their report, they conservatively pegged this peak closer to $135, likely reflecting a slightly lower gold valuation for that case. The logic remains clear. This forms the foundation of their base bull scenario. The headline-grabbing figure, however, comes from a deeper historical reference. Widmer's team examined the legendary Hunt Brothers episode of 1980. In that January, as the brothers attempted to dominate the silver market, prices skyrocketed, hitting a record around $4,945 per ounce. This extraordinary spike forced the gold-to-silver ratio down to an unprecedented 14 to 1, a level unmatched in modern memory. Applying that ratio to current conditions gives a striking result. $5,000 gold at a 14 ratio yields $357 per ounce for silver. That is the mathematical backbone of the extreme forecast. Bank of America's official headline, trimmed to $39, serves more as a stress test than a literal expectation. The calculation demonstrates that a price exceeding $350 is entirely plausible if two conditions align. Gold reaches $5,000 and the ratio collapses to 14 to 1. To be unambiguous, the bank is not promising a $39 outcome. They are illustrating a scenario. If gold remains robust and the gold to silver ratio returns to the 1980 extreme, the mathematics indicates silver could surge dramatically. This raises an essential question. Why would a financial titan like Bank of America invoke a 1980s style scenario today? The answer lies in the market context, which the model itself abstracts away from but cannot ignore. The physical silver market is exceedingly tight. For years, the Silver Institute has highlighted a persistent trend. Demand consistently surpasses mining output, steadily depleting above-ground inventories. This is no short-term anomaly. It is a long-term structural constraint. Reports show that London's silver stocks, one of the globe's critical hubs, have been declining sharply since 2021, setting the stage for a potentially explosive move. Moreover, silver is no longer a niche asset for coins or jewelry alone. It has become an essential, non-substitutable material for the green energy transition. Solar panels, electric vehicles, and nearly all modern electronics rely heavily on silver. This shift establishes a durable, high-demand baseline that did not exist decades ago. At the same time, the other side of the equation, gold, remains a cornerstone for investors seeking stability and protection, giving the ratio's movement heightened significance. In sum, Bank of America's analysis combines historical extremes with present-day market tightness. By comparing today's gold price to the ratio levels last seen in 1980, and overlaying the realities of constrained silver supply and surging industrial demand, the scenario demonstrates a mathematically plausible trajectory for silver, unlike anything suggested by conventional supply-demand forecasts. At the heart of this entire projection lies a strong gold price, fueled by massive central bank purchases, persistent inflation concerns, and gold's enduring role as a safe haven in turbulent times. According to Bank of America's research, even a modest uptick in investment demand could be sufficient to drive gold toward the $5,000 mark. Combine that with a historically elevated gold-to-silver ratio, a structural shortage in physical silver and surging industrial demand, and the result is the perfect storm for silver. The tight supply of physical metal acts as the tinder, and a wave of investment money could be the spark that ignites the market. It is important to pause and add a dose of realism. While the numbers are compelling, this scenario represents an extreme bull case. It is far from the mainstream consensus. Most Wall Street analysts continue to forecast silver landing somewhere between $79 and $90, with only a handful projecting as high as $150. Even Bank of America and Michael Widmer emphasize that these figures reflect what silver could achieve in a peak frenzy, not the level it is likely to stabilize at. The analogy to weather forecasting fits perfectly. They are not guaranteeing a hurricane will hit, but they are warning that all the conditions for a historic storm are forming so investors can prepare. The 1980s squeeze was a unique episode, driven by a deliberate market corner, while the 2011 run-up was powered by post-financial crisis money printing. Today, echoes of those conditions are visible, but history never repeats precisely. The critical insight is not the $39 headline, it is the reasoning. It reveals a shift in how silver is evaluated at the highest levels of finance, moving away from simple supply deficits toward a focus on monetary history and relative value. To summarize, Bank of America's move from a $65 target to a $39 scenario signals more than just a larger number. It marks a fundamental change in the approach. The analysis has shifted from a basic supply and demand narrative to a monetary history framework grounded in the gold-to-silver ratio. The calculation is straightforward. A strong gold price divided by a historically compressed ratio. A 2011-style ratio of 32-1 combined with $5,000 gold points to silver, ranging between $135 and $156. An extreme 1980-style ratio of 14-1 with the same gold price suggests silver could test $39 and, mathematically, even higher. While the $39 figure grabs attention, the underlying takeaway is that the strategies used during the 1970s and 2010s, when monetary uncertainty pushed investors toward hard assets, are once again relevant. This is not mere speculation. It reflects deep structural shifts in the market, recognized by some of the most influential financial players. Now, the question turns to you. What is your silver price target? Do you accept the ratio argument, or do you see this as institutional hype? Consider the logic, weigh the historical precedents, and think about the forces at play. The choice is yours. Observe, analyze, and prepare.